In this video, learn how to trade the Emotional Overextension Bounce Trade profitably. Hi, I'm Mike Bellafiore, co-founder of SMB Capital, and we're a proprietary trading firm located in Midtown Manhattan. And I'm also the author of the trading classic, One Good Trade, and the playbook. In this video, learn in step-by-step detail how to profit on a stock that's overextended. In this case, oversold, with a powerful trading setup. This is a super important trading lesson for you to learn so you can grow your trading account. All right, so we're going to do a playbook trade, and Jack's going to show you actually how to do it since he has more experience than a lot of you guys. So the whole premise behind the playbook is for you guys to be archiving setups that you really like, that you might be able to build your business around. So you're just starting, it's fine. The philosophy that we have at training is we're going to teach you guys the foundation of how to trade. So you're going to learn everything you need to learn about how to trade. And I've said this 100 times, and I'll say it to you guys again. You know, when you're an intern here, you're really going to learn how to trade. You're really going to learn how to trade. You're going to walk away with that skill. And you're going to see the difference between, hey, I have an idea as to whether or not AMC should go up, or I have an idea as to whether or not GME should go up, or I have an idea as to whether or not we should bounce on the open today. Today was a perfect example of this, where we're gapping down. There's news about the Delta variant maybe being a little bit worse than people had expected. Maybe there's going to be more of a global slowdown and reopening. Maybe that's going to hurt the economy more than people had thought again, and we saw the market gap down 1.5%-ish in the pre-market. And so you come in, and your question is, well, what's going to happen? And what we don't do here is, I just think the market's going to go up. I don't think this gap down makes any sense. What we don't do here is, yeah, I think this Delta variant's going to be way worse than people are pricing in right now. We're just all going to get short. That's not a trade. That's an opinion. And so what we do here is we take well-informed ideas, we take your ideas, and we teach you how to put them into a professional trade where you control your risk reward, where you're, most importantly, building from your unique talents. Everyone in this room has different talents, okay? And you think differently, you have different abilities. That's great. And we want you to be crafting your business around your talents. We'll expose you to lots of different ways that you can trade. And we're going to essentially put in front of you, here are different setups that the guys out there are using, or in this case, the guys virtually. There's some guys out there. The guys virtually are using to make a lot of money. Like, we're not making this stuff up. Like, we're saying, here are the things that guys who make 7 figures, 8 figures a year now, not like now, are doing. Here are the trades they're making. Try them. Try trades like them. You know, we're not like theorizing here. There are people that are making real money here doing the things that we're putting in front of you. But that doesn't mean that that's going to work for you. You know, for instance, we'll put in front of you a backside, low float short trade that Shark loves to trade. There aren't going to be 8 people in this room who are going to be able to trade that trade. It's just not going to work for all of you. But what's important is you get exposed to it. What's important is you just try it. Just try it. Like, this is your period just to try. Just try stuff. And there's going to be stuff that just doesn't work. You're going to be like, I can't believe that Shark shorts this stuff. It's so stressful. Like, this is like crazy to be shorting these stocks. You know, and there's going to be some of you who are like, oh, this is awesome. Like, wow, you can make so much money so quickly if you catch it right. The return on investment is awesome. I love it. But you shouldn't feel like just because somebody who makes money does it, that's going to work for you. That's not going to happen. And then there's going to be other times where you'll be watching maybe Steve on the AM meeting and him talking about a technical trade, and we'll put that in front of you, and it'll be like, oh yeah, that makes total sense. That's unlike how other people trade necessarily on the desk. That makes sense. I try it. I like it. It feels right to you. Those are the types of trades when it just feels right to you, when it makes sense to your brain based on your abilities, that you say, man, I need to playbook that. And you're going to help us with that. And you're going to essentially, your playbook becomes your business. There's going to be setups that you really like, that make sense to you, that you feel like you can build your career on, your career around, that in time you're going to dive deeper into them. And that's what you're going to be focusing on as you progress. All right, so the first thing, we're just going to teach you how to trade. And then the second thing is we're going to put some setups in front of you that work. And when we're doing that, pick out the ones that make sense to you, that you feel like you can build your career on, and playbook them. So anytime you see a trade that really works, that really makes sense to you, and you don't even have to have been in it, you want to archive it, you want to put it together in a playbook trade. Okay, and that's your business. Like, you're here to develop a niche, to develop a business. They're all going to be different. Every single one of you is going to have a different business. And go from there. All right, our senior intern here, our veteran in the room, Jack, go ahead. And Jack, do not call me Mr. Bellafiore going forward. It's Mike or Bella. You've been here too long to have to call me that. The rest of you have to, I'm just kidding. So, we're here to help. We're here. We're still, all of us are trying to figure things out day by day. Markets change. Trading's not the simplest thing in the world. We've been through it. We know that. But there are things that really work, and there are things that will really work for you, and that's what we're looking for. And that's why I make a big deal about playbooking them, because when we find something that really works, it's a huge thing. All right, Jack.
Yeah.
All right, Mr. Jack.
So today I'm going to go over some emotional overextension bounces in Voodoo and Tiger from Tuesday. Like Bella mentioned, this is a trade that makes sense to me. And over the past year or so of trading, these have been some of my biggest trades. All right, so for a trade overview for overextensions, I like to define what they mean to me. So an overextension occurs when a stock moves further than usual in a straight line. And there are two aspects to that in my mind. So price, where does it go? And time, how fast does it get there? And for me, the best overextension trades occur when they're setting up on multiple time frames. So when we have an acceleration and overextension on the daily or hourly, and also intraday when we find the same thing. So both of those have to line up for me.
Yeah, and I'll just throw in there, huge edge in that. And that's true to the short side, that's true to the long side. Huge edge in studying stocks that are overbought on the longer term and intraday, stocks that are oversold on the longer term and intraday. Putting those two things together, huge, huge edge for short-term trading doing that.
Yeah. So the main idea behind overextension trading is that the price action is not sustainable, like you mentioned, overbought or oversold, and it'll eventually lead to a reversion or retracement back to an established mean. And that's really up in the air for you to define what the mean means to you. So this does not necessarily mean that the move is over. So I'm not playing to catch a bottom or catch a top. I'm looking for a change where we can revert back to the mean, and that's the first step in the trade in my mind. So the mean can be VWAP or an established trend that we accelerated from and are pulling back into, just for example. But important in this trade is because we're up too much or down too much isn't really a reason to get involved. That doesn't make it a good trade. That's just predicting. It's a reason to pay attention, but other variables must line up. So despite being overextended to the downside, which these trades were, sellers are still in control and they're showing weakness. So in order for a real long trade to set up, we need to see a change in that. So we need to see a change in the way they're selling, and then buyers must take control. So the most common changes that I see and that work for me are an acceleration from the trend on volume expansion, so volume crescendos and increases that you can see it clearly on the charts, where we blow off and put in a clear turn. And also sellers, if we're playing it for a bounce, as in these trades, try to do something that they should be able to do if we're going to move lower and continue being weak and they can't. For example, a failed breakdown is an example of this.
there really is huge edge in being able to identify that blow-off move. And we'll show you examples of that. Maybe you're going to, but there's a visual of what that looks like on charts. If we don't show it here, we will at a certain point during your time here. And learning how to spot that and then trade off of that is just a terrific trade.
So a big thing with overextensions is the speed and the acceleration. And if we end up consolidating, these are areas where price resets and we regain energy to make a move lower. So if something spends a significant amount of time moving sideways after it's been sold pretty heavily, then for me, looking for that overextension out of the breakdown isn't a valid trade because we spent that time consolidating and building back up energy for a move lower and let the trend catch up. So if we have a failed breakdown, that's a different situation, but kind of scaling into that break out of the consolidation is a dangerous trade in my mind because of the energy that we have and the momentum we could have regained during that time. And also grinding price action lower is a signal of people buying, but it's different than downside acceleration on increasing volume. So the last thing that I want to do, and sometimes I've gotten caught in this situation, is building into a long, say if we're grinding lower and we're pretty far off, and then we start accelerating and setting up for the real trade, and I'm in a tough position where I can't fully take advantage of it. So I'm very careful not to stay away if we get that grinding price action lower. And the trade itself will make itself obvious if I'm paying attention and being patient, is what I found, especially in those situations after I've already gotten involved early and tried to predict it, that eventually when it does show up, it's very clear. So there's no need to try to be early, catch the absolute bottom, or lazily scale in and add until I'm right. The most important thing for these trades for me is to be there, be specific, like have specific reasons for everything that I do.
Yeah, and I would circle if I could, lazily scale in and add until I'm right. So there's a structural edge that we have as active traders. So we talk about edge. Edge is, if we do this 1,000 times, we're going to make money. Well, there's something called structural edge, which means you just have an inherent edge over other market players and not scaling in lazily and adding until I'm right, but rather I try it, it doesn't work out, I hit out and get flat, is a structural edge that you have. Meaning you don't have to be really big to make money as an active trader. Other institutions have to be really big. We don't. We can be nimble, we can be agile, and when you are lazily scaling in and adding until you're right, you're taking away your structural edge as a trader, which is huge. Like, if a hedge fund found a structural edge, it could build a $10 billion fund just off of that. A structural edge is bigger than edge. It's bigger than, a momentum trade works. It's like the basics of really being able to make a lot of money. And so to take that away from yourself is taking away really one of the things that you have in your arsenal that's most effective. So stay away from that stuff. You're shooting yourself in the foot. Does that make sense?
So getting into this specific trade, as I mentioned, it was in Tiger and Futu, but DD, the recent IPO, technology and software company from China, the news on that and Catalyst really set these up. So DD operates a mobility platform. It's essentially the Uber or Lyft of China. And they recently had their IPO and went public in the United States on June 30th, after the government of China, the Chinese government warned them not to go public in the US because they have very sensitive maps of China, including military sites, and also they collect a lot of user information. So, but anyway, due to pressure from investors, they went public anyway, and shortly after doing so, a regulation committee in China alleged that their app was collecting personal information in violation of relevant Chinese laws and regulations. So because of this, they removed their app from the App Store in China, so that new users, which are really a key metric for DD, especially when they announce earnings, that's one of the main things that you want to pay attention to, could not be downloaded, even though existing users could still use it. So This and recent regulation of other Chinese tech names like Alibaba, Tencent, and others sparked fear that the Chinese government would do the same to other Chinese technology names to prevent them from getting a lot of power, which may take away from the government's power.
If you want to learn 3 more real-world setups that our traders use, including the simple setup that we teach all of our new traders, and the setup that turned one of our traders into a 7-figure big money earner, check out the free webinar that we're currently running. Just go ahead and click the link that should be appearing now at the top right-hand corner of your screen. That will open up the free registration page in a new window, so don't worry, you won't lose this video. You can also visit tradingworkshop.com to register for this free intensive workshop. You're going to learn more in a couple of hours from this trading workshop than from years of online education.
Yeah, so this is the price action in the 3 days following, or 4 days following the IPO. So $14 was the IPO offering price. And we see that on day 1, it was sold hard. On day 2, kind of hung around. And then when they announced the investigation by regulators coming into day 3, pretty significant gap down. But the more important part of this to me is coming into day 4 when they announced that the app would be taken down. It gapped below the $14 IPO offering price, which is important because that's where investors are offered shares prior to the IPO, and that's where people are positioned from. So if you get those shares and now 4 days later you're underwater, you're in a really tough position, and it may spark more fear and weakness.
Yeah, that IPO price is a very important technical support level.
Yeah, and for the stock to gap that far down below it on this news is very significant. So then, like I mentioned, this announcement and the regulation into DD sparked fear into investors that they would do the same to other Chinese technology companies. So coming into that day where DD gapped below $14, Baba gapped down 1.2%, Futu gapped down 9%, Neo gapped down 2%, and Tiger gapped down 10.6%. And the key question coming into this day in my mind was, is this fear and reaction warranted? And does this emotional selling and gap down provide an opportunity with edge to trade? So because of this gap and the price action in prior days, which we'll look at in 2 key stocks, Futu and Tiger, they became overextended. So over the course of 2 days, Futu was down 18%, or 3 ATRs, or average true range, and Tiger was down 22%, or 2.5 ATRs. And as important as the start to end measurement for me is how they come off. So they were sold in a straight line with no significant bounce or opportunity for longs who are buying on the way down to get out. So the idea here is that emotional underwater longs coming into this gap down may end up puking their positions in the morning and provide some selling pressure for that acceleration downward. In addition, they were extending into some interesting prices. So it was into higher time frame support areas where the buyers have shown up before and proven themselves. And the idea behind this being important is that buyers positioned here might defend their entries and positions by buying more. So Futu is a financial company in the capital markets based in Hong Kong. They engage in online brokerage and wealth management services. And Tiger, similarly, is a financial company based in China. And they're also a fintech holding company which operates as a brokerage firm and focuses on global Chinese investors. Looking at the average volume for both, it's significant enough. Above 2.5 million is what I usually look for to provide liquidity for me to get in and out of positions. ATR, the average true range, how much do they move? I usually look for at least above 1 in most situations, and 10.7 and 2.6 were good for me. The float, which is how many shares are available to trade. So Futu has 54 million, which is pretty low, and Tiger has 128 million. And short float, which is what % of the shares in the float investors are short. When they're very high, like we saw in the recent meme stocks, people might take advantage and we might see a squeeze if price starts going up and these people have to buy to get out of their short positions. Pretty low in both, so around 5%. Institutional ownership, which is 29% and 9.6%, and insider ownership, which is 8% and 7%. So looking at the daily price action for food two, just pointing out the importance of the $140 area, which we were coming into and overextending into. It's acted as higher time frame inflection where buyers have tried to step up multiple times. And then we saw before the recent breakout, we actually consolidated here and buyers accumulated it, which is important because, as I mentioned before, if buyers are positioned from here, they'll pay a lot more attention psychologically to where their price is, because that's where they'll go red in their positions, and they'll often try to defend it by buying more. And even if we get below it, then they're in a tough position because they go from green to red, and emotionally they're put in a position where they have to make a decision or take action. So we'll zoom in more on a lower time frame, but in 2 days we're coming off from 180 to 147. And now in Tiger, we see the $22 area that we were coming into on the higher time frame. So sellers were stepping in into this area multiple times before they ended up lifting, and buyers took over after they reported earnings. So this is a recent support turned, or resistance turned support, again, where buyers are likely positioned, so the same importance as the $140 area. And similarly, we're coming off from $30 to $23 in 2 days. So as I mentioned, the way they're sold off during these extensions is as important as how far they go to me. So just looking at the 2 prior days, so day 1, we extend from VWAP with no real substantial bounces and closed at lows, a 1.5 ATR move. Day 2, on the open, we try to lift a breakdown area from the prior day, failed and consolidated below VWAP all day. And then coming into day 3, the day where the trade took place, we're gapping down another $14, which is 1.3 ATRs and close to a measured move of the move on day 1. So altogether, we're down $32, 18%, or 3 ATRs over the course of 2 days plus pre-market. And like I said, it's important that there's no real bounce or opportunity for longs who are buying on the way down to get out, because coming into day 3, especially if they were holding it, kind of expecting it to be flat or a slight relief bounce, they're well underwater at this point. Tiger, similar price action. So day 1, another extension from VWAP, consolidated at the lows and closed at the lows, almost an ATR move. Day 2, failed to lift on the open, and then we consolidated below the day 1 lows all day. And then coming into day 3, we have another ATR gap down. So similar situation, $2.6 down, 22%, or 2.5 ATRs coming into day 3. So again, another steep sell-off. So pre-market variables, kind of just summing up what I mentioned before, higher time frame overextended, 2 red days down over 15%, and over 2 ATRs. So it came off in a straight line with no significant bounces or ways for longs to get out, extending into a higher time frame support area where buyers have shown up and proven themselves. Large gap down into day 3, putting buyers from day 1 and 2 in a tough position and potentially leading to puking action on the open. And fear and emotion driving price action. The fear that regulators would step in and put similar penalties onto these companies as they did to DD.
Yeah, I'm struck by your underlying thinking here. Came off in a straight line with no significant bounces. I think you're onto a pretty important point here. I think you also might think about, and I think this is pretty clever and savvy. I think you might also think about, there are certain hedge funds and institutions that when things start going against them have to get out just because they're underwater too much or it's just down too much. They just have to. I think a lot of times people think hedge funds take a lot of risk and can draw down a lot, and that isn't true right now. It certainly isn't as true as much as it used to be. And so when they're down 3%, a lot of them have to start hitting out. And so, and I'm sure, so the people that were long, who were some hedge funds or institutions who were long those names, they kind of have to get out because of the price. And so I like adding that thought. I'll just give you that to think about, which I think complements came off in a straight line, no significant bounces for the longs to get out. It's almost like there's synthetic selling. There's forced selling that is driving this price lower. That when it turns is interesting because maybe we're just down too much because of that forced selling. Anyway, something to think about.
Yeah, that makes a lot of sense, especially when there's the real change and they're done selling, getting out, then there's not that selling pressure and can lead to a nice move. In my playbooks, I like to look at different steps in a trade. And what's interesting to me about Tiger and Futu was how they bottomed differently and how the trade set up differently, even though they were very similar prior days in price action. So looking at Futu first. So off the open, we kind of put in an opening range where the seller stepped in and remained heavy, and we started pressing lows. But like I said, I like to look at overextensions on multiple time frames. And as a result, just an opening range is not an area where I'd be very interested in buying. So this is something I really like to remind myself, especially given that we're down so much and gapping down so much, but there's not that intraday aspect to it yet. Yeah, so then we break down this opening range and grind to new lows with the seller still clearly in control and showing more weakness. So as I mentioned with the consolidation point earlier, on a fresh breakdown from a consolidation like this, we're not overextended. So I like to continue paying attention to price action, but not really interested in looking for that acceleration buy yet.
This is day 4?
Yes, yeah. So the day that these gap down with DD. So also note the lack of volume expansion on this move. It's kind of holding steady. If we're extending intraday, then what I want to see is volume increasing and crescendoing as we accelerate to the downside. So that's something else that I'm looking for that's not occurring yet. So we make another push lower, and just note the change in the way we sell off versus the first leg from highs. This time it's steeper and cleaner with sellers stepping down on increasing volume, as we see.
And Jack, what chart time frame is that?
This is the 1 minute.
Okay.
Yeah. So this is 45 minutes after the open at this point, 10:15. At this point, we're down into 140, which was that longer, higher time frame level that I pointed out on the chart. We're down half an ATR from VWAP intraday, which is kind of a way I like to measure intraday extensions based on how far we are from where the average buyer is positioned from. And we see a spike in volume as we flush below that 140 level. As you see, the last candle on the chart has the highest volume since the open. When we see this kind of volume increase on a flush following this kind of steep down move into a key area that is now extended from intraday VWAP, I kind of pay very close attention to whether sellers are able to drop and stick lower. So if not, and we see buyers step in and sellers start lifting differently than before, then this might be a real change and a reason for me to get long. And also looking at the measured move, it's kind of the same size as the first leg before the mini pop, which is also something to note. So sellers try to step down and stick lower beneath the flush area and 140, but fail to do so. And we might see on the tape, but they spend about 4 minutes beneath 140, hitting the bid pretty hard, but they're unable to drop it. And in that situation, when I think about what should happen and doesn't, they should be able to move significantly lower from 140. But since they can't, this is an interesting point to me. So after this, we can see those 2 quick green bars. We see a change in the way that they're selling, and the buyers step in and lift it. This is a real change because sellers should have been able to drop out and stick and remain heavy under this important area, but failed to do so. And then this failed break lower led to a change in the way that they were selling, and the buyers took control. So I sort of had to have a thesis that this might be important, that they can't get lower here. And then when I see the offers lifting differently and the buyers stepping up and absorbing on the bid above 140, this confirms that and is a reason for me to get involved.
Yeah, I mean, to me, the key is looking for the big red candle on the volume.
Yeah.
That's what you really want. You want to see it, and you do want to see that puking action. That's a very powerful trade. For the inverse of that, the blow-off action, but it's the volume. It's really, you're really looking for that huge, bigger red candle of volume that denotes, hey, they've puked this, they're done selling. That's what that's saying. We've got an oversold condition on our daily charts. We've got an oversold condition on our intraday charts. End. We're getting that signal of the puking action, of the people just giving up. The huge volume bar is really language that market traders are using, which is, I give up. I'm out. I've had it. I can't take it anymore. I've puked my longs. They probably are puking on the desk if they're selling. They're down a lot of money. They're giving up. They're like, that's it, I'm done. That's what that big red volume candle speaks to us about. So good, and it's even better that it's into a longer term support area.
Yeah, and sometimes from that puke candle where the volume really increases, they'll pop it back up. Iteration that I've seen where it tries to press that low put in by that one candle, fails to do so, and then we get the change, which is interesting. So following this change at the lows, after the extension on multiple time frames, price breaks that intraday downtrend and quickly bounces back into VWAP. So I like to think of my trades in terms of steps. So the main question at this point in my mind is whether the buyers can step up, hold above VWAP, and reclaim that opening range where we broke down from, earlier. So yeah, the first step of this trade for me is that quick move back up into VWAP. And this trade is over in my mind, but if now we can hold up and buyers can remain in control, given that multi-day extension, another step of the trade may lead to legs higher, where we see the higher time frame reversal as well.
Yeah, I'd play around with leaving some on. Think about it. VWAP is going to be a measure of how the stock is trading intraday. Mm-hmm. If it's puked, what's VWAP really going to be at? It's going to be too low.
Yeah.
If it's overextended on the longer term and the intraday, it's going to bounce pretty hard. So you might think about using VWAP as a signal to take some risk off, but I'd play with keeping some on and seeing how you do there.
Yeah, so we'll see executions, but I took half off into VWAP and when they failed higher. Yeah. So we hold up around VWAP for about 15 minutes. We try to lift and see some weakness and failures above the opening range lows. So at this point, the trade's over for me, especially coming into the midday session after this extension to the downside and now substantial retracement. I like to give the stock some time to reset and regain energy rather than trying to press right here and waiting for something to happen, or trying to make something happen, in other words. So this was Futu. Now, moving on to Tiger, similar situation off the open, but very different in the way that they bottomed and bounced. So similar to Futu, opening range put in right off the open, and just to reiterate, not interested at this point, just paying attention given the higher time frame overextension and looking to see what happens next. So we break down the opening range and flush down into new lows with the sellers hitting the spray ups, which are quick pops, which we'll often see get hit hard if we're selling off on momentum. The price flushes that longer term $22 area, retests on that quick pop up, the last pop up before the last candle in the chart, and then fails lower on a big wick on elevated volume, the low of which is about half an ATR below VWAP, which was similar to where Futu ended up making its low. This kind of price action lower is different than the grind lower in Futu. These are quick flushes that aren't seeing the same sellers gradually stepping it down lower. So at the same time, the sellers are still in control and showing weakness. So in order for the long to come into play, we need to see a failure for sellers to break down and then a real change in the way that they're selling. Sellers tried to roll and make new lows, but failed to stick below 2150, which is that line. Buyers step in and the sellers lift, and we see a change in the way that they're selling, which was mostly a tape trade that we can see on the tape. So given the extension from VWAP intraday, the flush lower price action versus the grinding, which I would be less inclined to get involved after, and the failure to get lower followed by the change in the way they're selling it on a flush of higher time frame support area, which was the $22 level. This is an area where I was looking to get long and I ended up buying. After this change, sellers actually step in above 22 and try to roll again, but those buyers that we saw the initial change at 2150 when they stepped in and lifted. They step in and continue holding up, not even letting the price retest the lows. And this is a pattern, a common bottoming pattern that we see in many stocks. So they'll make that hard move lower, sort of bounce a little bit, and then look like they're going to roll. But then we see buyers step up, and they can't even retest the lows, which is important in my mind.
Yeah, and I think the other thing you're thinking about is 22 is the support level, right?
Yeah.
And you're below 22.
Yeah.
And when you're below the support level at 22, what are you thinking?
Should get lower.
Should go lower.
Yeah.
And then you see you can't get below 2150. That's odd. And then you see you can't get below 2150. That's odd. And then you see you can't get below 2150. That's odd. And whenever you see something odd like that, and you hone into the tape, that can be a signal from your tape reading that they've just decided they're just not letting this go lower, and it's weird, you know. And so when something is happening in the marketplace that should not be happening, that's a big signal. And you want to be open-minded to. I mean, most traders are sitting there when it's below 22, and they're like, "Well, this thing's going to go to 18. I mean, this isn't done here. It's got below this big, longer-term technical support level. I mean, it's going to tank." And then it's just not. That means some big institutional, big money buyer is buying, and we'd like to follow that person. So, good to be open-minded to that.
Actually, under 22 especially, they accelerated, and it looked like it was going to get lower, and then it just didn't, which was the pop off of there. So then we get a slight pop off of this area right at the end, the last couple candles. And the question in my mind is, can we reclaim the $22 higher time frame support and have buyers step up and take control? Price popped right above $22 after the buyers held 21.50. The buyers stepped up, and we consolidated really tightly for 3 minutes there, right above 22, with those wicks to the upside. So we saw sellers trying to drop it, but not able to. And then right after they were unable to get lower, we popped up above VWAP. So similar thought process here to Futu at this point. So the first step of the trade is over, which means I want to be lightening up into this and seeing what happens next. So can we reclaim those opening range lows, hold above VWAP, and then make a move higher, given the higher time frame overextension? And can this trade become something more than simply a scalp, essentially? Price actually tried to roll back into 22. We see buyers step up and then try to make a move back into opening range lows. And they wick above, fail to get above and hold. And the trade at this point is over for me. That doesn't mean that I'm not watching it anymore. It just means that this particular trade is over, and I want to be flat, especially into the midday to see what happens next. So some key trade variables, just to recap: the intraday extension on the lower time frame, after that extension on the higher time frame, in terms of an acceleration from a prior established trend, and distance from VWAP in terms of the ATR. Increasing volume, so I'd like to see volume crescendo as we accelerate to the downside and become extended intraday, and a real change occurs. So we either see a blow off in extreme volume with a clear turn, or sellers fail to do something that they should. For example, when we got below 22, they should have been able to get it significantly lower fast. They could not do so. They should have done that if we were going to continue being weak, and this caused a change in the way that they're selling, and buyers took control.
Well, I think the other important variable is you're used to the long-term support areas.
Yeah, that was on the pre-market variables.
Okay. What was that? What were those variables?
I guess intraday variables.
But isn't that part of the
Yeah, I can put
what's
them
making
on.
the trade?
Yeah.
I'm just pointing that out because you're not going to always. I think it's a really good job that you did setting the trade up, looking at the longer-term support levels, because there's going to be trades where they don't pull in towards longer-term support areas, and they're still going to be good trades. But when they pull in towards, when they do all this stuff, intraday extension, increasing volume, real change occurs, and you're near support areas, that's going to make the trade even better. This is 100% an A+ trade.
Yeah, and something I'll add there is if we're already overextended intraday, especially into an obvious level where there are likely stops positioned below it, then those stops getting run may provide artificial selling, which may accelerate to the downside and allow even better entry. I was patient and did not overexhaust before the real trade set up. Had specific and clear reasons for doing everything that I did in the trade, and was clear about the type of trade that I was making and didn't try to turn it into something different. Area for growth, we talked about. I need to grow on my ability to stick with the trade and get more aggressive as it proves itself, essentially pressing on it when it's working. In both trades, my only real buys were when I saw the change, that initial change, and then the trades became better trades, stronger trades, following more variables and steps playing out. Like we mentioned, the 2150 buyer holding and the real change above 140, as I mentioned lower.
Good, and I just want to point out, we'll end here. This is a great example of the difference between, I think the stocks should go up. I mean, you're probably watching these stocks go down and many times said to yourself, they should start going back up again. Like, what's going on here? This is an overreaction. And they didn't. And then you then found a place to put a trade together with variables. So it was overextended intraday, and on your longer term charts, it was near an important technical level, and then you saw it change. And you could point to what you define, I see a change as. That's a trade. That's a trade that goes into a playbook. That's something that goes into your trading business. That's something you can build a career around. I think it should stop going down is not. Hey, go ahead and click our subscribe button so you don't miss any of the videos that we're producing for you in the trading community. And please take the time to add your feedback in the comment section for what videos you'd like for us to produce next and what you found helpful from this video. From all of us at S&B, train and trade well.